Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the hidden stories within corporate filings. And today we're looking at MBC Funding 2 Corp. Get ready because this company is playing a very specific game with its finances. This report, a Form 10Q, gives us a peek at how MBC Funding 2 Corp is doing financially. Especially for the period ending the 30th of September 2025. It is like a quick checkup for the company's health. So, what is the main business here? MBC Funding 2 Corp doesn't actually originate loans itself. Instead, it buys a pool of mortgage loans from its parent company, Manhattan Bridge Capital, or MBC. Think of it as a way to hold onto loans and use them as collateral for its own debt, which are these senior secured notes. Let's jump into the meat of the report, the financial statements. This is where we see the real numbers. Looking at the balance sheet, a snapshot of the company's financial position, we see loans receivable as the main asset. For the 30th of September 2025, these loans stand at about $8 million, which is a bit down from over $8.7 million at the end of 2024. This decrease in their main asset is something we'll want to keep an eye on. Cash is pretty small, around $62,000. On the other side, we have liabilities. The big one here is their senior secured notes, which total almost $6 million. These are essentially loans the company has taken out, and they are secured by the pool of mortgage loans they hold. They also have some other smaller liabilities. Under stockholders' equity, we see retained earnings, which represent the accumulated profits of the company. This has grown nicely from about $3.8 million at the end of 2024 to over $4.1 million by September 2025. This shows the company has been profitable. Now let's look at how the company is performing over time. The statement of operations tells us about their revenue and expenses. For the 3 months ending the 30th of September 2025, their revenue, mainly interest income from these loans, was about $230,000. This is very close to the $228,000 they made in the same period last year. Their major expense is the interest and amortization of deferred financing costs related to those senior secured notes, which was about $108,000 for the 3-month period in both 2025 and 2024. This cost is pretty stable because the notes themselves and their interest rate haven't changed. Despite the slight decrease in revenue for the 9-month period compared to last year, the company still reported a net income. For the 9 months ending the 30th of September 2025, net income was about $321,000 compared to nearly $355,000 in 2024. This reduction in profit is directly linked to that decrease in interest income from the loans. The statement of changes in stockholders' equity reinforces the story of profitability. We see net income being added to retained earnings in both periods, confirming that the company is generating profits that are being reinvested back into the business. Let's look at cash. The statement of cash flows reveals how money is moving in and out of the company. For the 9 months ending the 30th of September 2025, net cash provided by operating activities was about $362,000. This is lower than the roughly $406,000 from the same period in 2024. This drop is mainly due to that decrease in revenue and some increase in prepaid expenses. Financing activities show a consistent pattern of advancing money to their parent company. MBC, this is essentially what happens with excess cash after covering expenses and interest payments. They used about $350,000 for this in 2025, down from almost $400,000 in 2024. A notable supplemental disclosure here shows how loans are being managed between the company and its parent. The numbers for assigned loans repaid to the parent by borrowers are significant, over $4.9 million in 2025. This highlights the flow of money and loan activity within the corporate structure. The notes to the financial statements provide crucial context. It clarifies that MBC Funding 2 Corp was formed by Manhattan Bridge Capital, Inc. specifically for an initial public offering of its notes. They don't originate or service loans themselves. The loans they hold are collateral for their senior secured notes. Their 6% senior secured notes are indeed listed on the Nice American under the ticker symbol Loan 26. This means these notes are publicly traded debt instruments. A key requirement known as a covenant is that the value of the mortgage loans they hold, plus their cash, must always be at least 120% of the outstanding principal amount of their notes. This is a safety net to protect the note holders. In the commercial loan section, we see the breakdown of their loan portfolio. As of the 30th of September 2025, they had 12 loans totaling about $8 million. This is down from 16 loans totaling over $8.7 million at the end of 2024. The loans are primarily in developers, residential and developers' commercial categories. There is a noticeable concentration of risk, As of the 30th of September 2025, a single borrower accounted for 19% of the total loans receivable. Another borrower represented almost 19%, and a third close to 13%. This means a significant portion of their loan income is dependent on a few large borrowers. The management discussion section offers their perspective. They reiterate that they hold mortgage loans acquired from their parent MBC as collateral for their notes. They plan to redeem these notes eventually using proceeds from a replacement or MBC's existing credit facility, though they can't guarantee it will happen. Management admits that the decrease in revenue for the 9 months was mainly because they have fewer loans receivable. This aligns with our observation of the declining loan portfolio. Regarding liquidity, the company had about $63,000 in cash at the end of September 2025. They believe their current cash and expected cash flow from operations will be enough to keep them going for the next 12 months. Interestingly, they state they have only one reportable segment. Since they don't originate or service loans, and the loan portfolio just acts as collateral, they evaluate performance on a consolidated basis. This means there aren't really separate businesses to analyze within the company. As a smaller reporting company, they are exempt from providing detailed market risk disclosures, which simplifies things for us. Then we have the standard disclosures about controls and procedures, confirming that management believes their internal controls are effective. There were no significant changes in these controls during the quarter. Finally, the exhibits list includes standard certifications from the CEO and CFO, along with the interactive data files required for electronic filing. So, what is the story here behind all these numbers and statements? MBC Funding 2 Corp is essentially a financial conduit. Its entire existence revolves around holding a portfolio of commercial mortgage loans acquired from its parent company, MBC. These loans serve as the collateral for the senior secured notes that MBC Funding 2 Corp issued to the public. The company is profitable, as shown by the steady increase in retained earnings. However, the core business, which is generating interest income from loans, appears to be shrinking. The total value of loans receivable has decreased, and consequently their interest income has also seen a slight dip. This decline in the loan portfolio is the primary driver of the observed reduction in revenue and net income for the 9-month period compared to last year. A key takeaway is the concentration of risk. A significant portion of their loan portfolio, and therefore their revenue, is dependent on just a handful of borrowers. This makes the company vulnerable if any of these major borrowers face financial difficulties. The company's strategy seems to be to maintain the 120% collateralization ratio with their senior secured notes and to use any excess cash to advance to their parent company. They express an intention to redeem these notes prior to maturity, but this is contingent on securing new financing or credit facilities, which is not a certainty. Looking at strengths, the company consistently generates profits and maintains a strong liquidity cushion relative to its operating needs. With a clear intent to protect its note holders, the downside is the lack of growth and the potential risks associated with loan portfolio concentration, and the stated intention to redeem notes which is contingent on future events. In essence, MBC Funding 2 Corp is a stable but static entity. Its financial health is directly tied to the performance and volume of the loans it holds from its parent. While it appears to be managing its obligations and generating modest profits, there is no indication of aggressive expansion or new business initiatives. The primary ongoing risk is the concentration of its loan portfolio within a few borrowers. Alright, that is our breakdown of MBC Funding 2 Corp. Slate is filing. What is your take on these numbers and what they signal for the company's future? Do you think they can successfully redeem their notes? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community discussions. Thanks for watching, see you next time.